Hello there. As people come on in, I want to say welcome. Thank you so much for joining us today. I'm Marche, the webinar director at Advice Chaser, and we're so glad you're here. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational event. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenter will answer those queries during the presentation or during our question and answer period at the end of the presentation today. If you ask a question and we're not able to get to it, go ahead and leave your contact information as well in the chat box, and we're happy to reach out to you after today's event to make sure your question is addressed. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. We're happy to help. Well, I'd love to introduce you to our presenter today. And let me go ahead and get that slide up so you can see. Ethan T. Brown has a bachelor's degree in political science from the University of Michigan and an MBA from the University of Massachusetts at Lowell. He joined Cox Capital in 2015 and became a partner in 2020. His primary responsibilities include equity and fixed income research, portfolio management, and meeting with clients. He holds the CFA and CFP designations. Ethan is a former national champion triathlete and an Olympic trials qualifier. In addition to his role at Cox Capital, he sits on the board of directors for the Drake Academy of Excellence. Ethan, this is a super great topic to talk about right now, especially considering the current environment. So I know we've had a lot of response to our invitation to this webinar, and we're really excited to get to it. So I'll turn the time over to you.
All right, perfect. Thank you, Marche, and thank you to everybody for tuning in today. This is my third time doing a webinar with Advice Chaser, so they haven't blacklisted me yet, so I must be doing all right. But the goal today, I mean, we want to give you an overview of inflation. Essentially, inflation has been non-existent for a very long time, and now it's at a 40-year high. So we'll kind of talk about the events in the world that took place to kind of get us to where we are now, and hopefully give you some good tips and ideas for how you can kind of combat inflation and protect your net worth, essentially. And again, and I'll reiterate too that any views expressed here are my own and my firm's and not Advice Chaser. But so you can see we have an agenda for you here. And really quickly, we'll kind of run through and define what inflation is. We'll examine kind of the supply and demand dynamics that got us to be in the situation that we're in. We'll talk about some of the long-term consequences and where we think that inflation could go from here, why it's harmful. And certainly we try to break the presentation down into two parts, I would say. One is kind of the big kind of macro overview of how we got to where we are. And then the second is kind of more micro focused. They're focused on personal wealth and some steps you can take to kind of mitigate the bad effects of inflation. And certainly along the way, like Marche said, if you have any questions, feel free to type them in, and I'm happy to kind of get to those as they come up. So to start, inflation is essentially when prices go up. The general increase in prices, that's what inflation is. And it's bad because inflation essentially erodes the purchasing power of your money. So you go to the grocery store every week, say you spend, $100 to get the same kind of group of products that you always get. Well, if all of a sudden prices are 10% higher, then your $100 cannot buy that same basket of goods. So effectively, your money is worth 10% less if all the goods you normally buy have gone up 10%. And that kind of leads us into defining what a real return is. And so this is a finance term. Essentially, what it is your return after you adjust for inflation. So if your money is sitting in the bank, earning $0 and inflation is 8%, which it is right now, then you're effectively earning negative 8% in real terms. If the bank interest rates were to go up and they were to pay you, a 4% interest rate on your deposit, then that real return would only be negative 4% because you're offsetting some of the deteriorating effects of inflation in that case. But there's two kind of widely accepted indexes that measure inflation. The most popular is probably the CPI, the Consumer Price Index. And you can look this up. You can go to the Bureau of Labor Statistics website or just Google it, and you'll be able to find the whole data set. The government reports this number every month. And essentially what the Consumer Price Index is it's like a theoretical basket of goods that the government determines, okay, the average household in America, they spend 40% on rent, 20% on food, 10% on gas, and so on. And then they measure the price increases across all those different categories and kind of come up with a weighted average. And so that's what the CPI is. The other measure that's not quite as popular is the Consumption Expenditures Index, the PCE index. And this actually measures what people are spending money on and how much those products and services are going up. So the difference between the two is that the Consumer Price Index, they've been criticized because it's this theoretical basket of goods that can be slow to change over time. If people's consumption habits are changing, then that CPI, the weights in that basket should be changing as well, but they're typically slow to change. And so that's a criticism of CPI. The PCE gets at what people are actually spending money on and measures those things. So the Federal Reserve, for instance, their preferred measure of inflation is this PCE index. Another kind of subset to all this is what's called core inflation. And so there's a core CPI number, and then there's a core PCE number. And what this does is it strips out the effects of food and energy in these two different indexes. And the reason it does that is because food and energy tend to be extremely volatile month to month. So in order to give these indexes like a little bit more of like a smoothing effect and not be so volatile, that energy and food component is stripped out. And so the Federal Reserve, for instance, they like to look at the core PCE index, which is PCE minus food and energy. You can criticize that too, because we all spend our money on food and energy. So to try to take that out of the index, just to smooth it over, sometimes isn't always, as practical as they think it might be. But at any rate, the CPI index reading last month was 8.6%. Again, that's a 40-year high. It hasn't been since the early 80s that we've experienced the kind of inflation that we're experiencing. And what's driven this is kind of the supply and demand dynamics over the past couple of years. It's had a massive impact on prices of goods across the world. And so we'll go in and we'll examine the supply and demand components by themselves right now. So on the demand side, it can really be summed up with like COVID threw a wrench into everything. COVID completely changed people's consumption patterns. So when COVID first broke out, you had this big pantry stocking effect. So everybody went to the grocery store. They were buying everything left and right because they wanted to do larger orders of shopping because they wanted to make less trips out of the house, and they didn't know how long we would be in lockdown. So it really created a surge in demand that kind of depleted the inventory of grocery stores all around the country. And so that was kind of the first change in consuming habits, was this big surge in kind of grocery items now that we're all going to be forced to be quarantined at home. As people settled into lockdown mode, service spending shifted away from leisure and travel and socializing, going out to eat, and things you can do when you are free to move around. So they went away from all those services and more towards products, essentially. I mean, people were at home, so they wanted to make improvements to their home office and go to Home Depot and get any items they need to do that. They were bored at home, so they went on Amazon and went online shopping. I know I got a ton of Amazon packages back in March of 2020. And so spending shifted. You saw some big popular companies like Peloton, Zoom, for instance. I mean, these things really became popular during COVID. So you had, again, this pantry stocking effect depleting the inventory of all the grocery stores. You had people wanting to shift all their spending on to products or kind of stay-at-home services. And that was occurring right at a time when travel around the world was being halted. So after the grocery stores were out of inventory, they couldn't really replenish. And likewise, I mean, many businesses around the country, if they were deemed non-essential, they had to shut down. And even some essential businesses, right when COVID broke out, I mean, people were very nervous about the economy. So you saw a lot of companies, they halted spending, they pulled back buying more inventory because they just didn't know what was going to happen in the world, basically. Well, what did happen was people were quarantined at home. They were saving a lot of money because they weren't kind of going out and about and spending money in the world. The government was injecting stimulus into the economy. People were getting higher unemployment benefits. They were getting $600 a week to stay at home, essentially. And so what happened was demand kind of came back. It didn't go away. It came back stronger than ever before. And then again, as you had this reopening, when the first wave went down, and then in subsequent waves, as they subsided, people started going out again, and there was this huge pent-up demand for travel and restaurants and going out and having experiences that they couldn't have over the previous year, basically. So not only was demand back and better than it was better than ever. People had healthier balance sheets because they had saved money during the pandemic, and the government had given them stimulus. So it was really this perfect storm for demand to surge. And this especially was true in the real estate market. I mean, the whole COVID working at home experience made people realize that they didn't have to go into the office every day. So maybe they only go in once a week. So they want to buy a larger home, out in the suburbs next to a lake where they have a home office and can work there most of the time. So it created massive demand for more space as well. And we've had a housing shortage in this country. Since the 2008 financial crisis, we have not built enough homes at a fast enough rate for all the people looking to buy a home is out there. So there's been a mismatch in supply and demand there. But so yeah, to sum it up again, people pent up demand. They had a lot of money in their pocket, and they really wanted to just get out and spend at a time when what was going on the supply side was kind of the complete opposite.
All right. Oh, let me move on to the next part here.
Right. So there's this huge wave of demand that I was talking about, and it occurred at the same time that you had that pantry stocking effect, depleting inventories, people staying at home wanting to buy products, depleting those inventories. This is going on when supply chains around the world are just kind of in disarray because international travel was halted. So much of the world's production comes from China. China has the strictest COVID policy in the world. So if there's one case at a factory, that whole factory is shut down. If that factory makes essential components for autos or iPhones or whatever it is, I mean, then you just can't get that. And so it messes up the whole supply chain. And that's what we're dealing with right now. And even though we're, over 2 years removed from the onset of COVID, this whole supply chain issue is still very much in bad shape. And there's very, very slight signs that it's starting to be alleviated a little bit. But I mean, that's what's really resulted in this inflationary effect, is this wave of demand coupled with just complete lack of supply for all these structural reasons. And so over the past 30 years, American businesses have been kind of outsourcing all their labor and production to countries like China, where they can produce at lower costs. And so this has been a big wake-up call for those companies, because they realize that doing that is a huge risk, because then they might not have inventory to sell for a year. And so we're dealing with a whole semiconductor chip shortage right now, and that's literally affecting everything from cars to computers to iPhones. And so it's really been just this perfect storm of two events coming that's really created this inflationary effect. Now, to make matters worse, on top of this, as the economy reopened and people wanted to go back and travel and go out to restaurants again, it's really become apparent that there's a massive labor shortage in this country. So there's simply not enough service workers to meet all the demand out there. And even today, we still have about 1 million less workers in the economy now than we did before the pandemic broke out. And part of that is due to this great resignation effect that you may have heard about.
Yeah, I was going to ask if that was the reason why we have 1 million less workers.
Yeah, it's partly there's a subset of the population that is at risk health-wise, and so they still do not feel comfortable going out. But then there's another portion that are just they're sick of the way workers are treated, and so they simply don't come back in. It's creating some opportunities, because there's never been more job openings relative to the amount of workers looking for jobs out there. But I mean, one of the other kind of, this is not completely related, but workers during COVID, I mean, people became a lot less willing to put up with bad working conditions. Essentially, if you had a boss that wasn't going to let you work from home, was going to make you work on a Saturday, well, I mean, there's so many other jobs out there that, hey, you can go make more money somewhere else and have a better quality of life. So why are you going to stay there? So that's what we're dealing with. But again, an undersupply of service workers is really hurting a lot of industries right now as well. And then the final point on this slide is that just as supply chains were coming back online, you have this war between Russia and Ukraine that breaks out, and that continued to throw things into disarray. Ukraine is a huge supplier of wheat, and Russia is a huge supplier of oil. Those are two kind of essential inputs in virtually a ton of food, and oil is something that it's ubiquitous in nature, and it's needed all around the world. So a lack of supply in those two areas further put upward pressure on prices. So that brings us to today, where inflation has gone from 1 or 2% up to 8 or 9%. So we're going to kind of transition now. That hopefully gave you a big picture sense of like why we got to where we are, why we have inflation. It's been this supply and demand dynamic that has gotten thrown all out of whack. So what are the long-term consequences of something like this? I mean, nobody really knows, but I've seen some interesting arguments speculating on what the consequences will be. And so we're going to use this to kind of transition to some of the more micro level things that you can be doing to combat inflation. But so there's a concept of deglobalization, which is kind of interesting because, like I said, over the past 30 years, we've been outsourcing our labor and production to lower cost countries. And we did this because it was cheaper to produce, and so companies could have higher profit margins if we did that. But COVID has exposed an enormous risk to doing that. So every business school in this country for the past 50 years has taught something called just-in-time inventory, and that is essentially the businesses want to maintain as little inventory as possible because inventory is expensive to maintain. I mean, it has to be insured, it could be damaged, you have to buy a warehouse to store it all. So the lower the amount of inventory you can hold while still meeting demand, just getting shipments on a kind of more regular interval, that's what you do to maximize your profit margins. Well, that just in time model is switching to just in case, where companies are realizing that they need to have a second source of supply. So what I think is going to happen is you're going to see a lot of not offshoring, but onshoring, where companies are going to bring their production lines back from China domestically so that they can control every aspect of production. And this is going to allow them to be a lot more confident in the fact that they won't run out of inventory if maybe they continue to keep their offshore supply line, but at least they have a backup plant at home where if things get dire and with all the geopolitical events going on in the world, if relations sour, it's not a risk to them because they have that backup there. So what that is going to do is it's going to create a lot of investment domestically. So companies have spent a lot of money building plants in China. Well, now they're going to spend money building plants, in Ohio and Michigan and here. And you're already hearing news of like Intel building a $40 billion plant to make computer chips in the US. So you're going to see this, I think, from a lot of different companies. And what that's going to do is it's going to shift a lot of power back to workers. So over the past 30 years, outsourcing everything, if you had a union in your company and they said, we want high pay and good benefits, you could just fire everybody and go ship out your production to China. Well, you can't do that anymore, because of what COVID has exposed. So you're going to have workers that are satisfied, paid a living wage. And so I think that's going to have a big kind of bargaining effect for a lot of unions and workers at big global firms domestically. So it could be a very good thing for the American middle class. And you're already kind of seeing this happen with, I just wrote down a few examples: Starbucks, Apple, Amazon. If you read the news, you see that these companies are starting to have unions form all across the country to help their negotiating power and to lobby for better conditions. So I think that is likely to continue. And because we do have this lack of labor in the country, you're going to see a continued investment in automation and robotics. Simply if you just can't find the workers you need, then innovative companies are going to innovate, and they're going to find ways to get around that and become more productive with less labor. So if you're looking to switch careers, automation, robotics, AI, I think that's a hotbed, and that's only going to increase in years to come. And ultimately, inflation very likely is not going to stay at 8 or 9%. I mean, supply chains will start to even out again. It should bring down prices. And oil's probably up 100% in the past year. It's when you kind of get back to the year-over-year effects, it's not likely to be up another 100%. I mean, I don't know. You can't predict what markets do, but it's very unlikely. So it's going to come down, but the big question is, where is it going to settle in? Is it going to settle in at 4%? Because that would be more than double where it was pre-COVID, and that would be very, very high. Is it going to be 3%? So nobody really knows, but given the fact that we have these supply-demand dynamics that are going to take years to fix, I think there's a good chance it remains elevated well above 2% for the foreseeable future.
I did have a question here. Can you
Sure.
speak to what historically inflation has been over the past couple decades?
Yeah, yeah, definitely. Yeah, so from excuse me, from 2010 to 2020, that core PCE index that the Federal Reserve looks at, that's probably averaged, 1.6%. So the Federal Reserve say that they have an inflation objective of 2%. So the past decade, it's been below that. The previous decade, 2000 to 2010, it was a bit higher. I don't know the exact number, but I would guess in the like 3% range. So it did run a bit higher. And so in terms of where things are going to kind of settle out now, I think there's a good probability that we run a little bit hot above that 2% objective, at least for a little while.
Okay, thank you very much for that question. I want to tell participants, please go ahead and put your questions in the chat.
Yeah, so why is inflation harmful? So I gave the grocery store example. It erodes the money that you have. And certainly inflation is scary. I mean, right now, the University of Michigan conducts this consumer sentiment index where they ask people, how confident are they about the economy going forward? And it recently hit an all-time low. So it was lower than it was in the global financial crisis in 2008. Really because inflation has just surprised people. It's been our problem before 2020 was almost deflation, and now it's inflation. So it's not something that people are accustomed to, and it can have damaging effects, which I'm talking about right now. So the stock and bond markets, they're both really getting killed this year, for lack of a better term. And that's due to interest rates going up is going to hurt fixed income, because when rates go up, prices have to come down in the fixed income world. And then in the stock market, it's starting to dent the real economy in terms of higher inflation, higher interest rates are starting to slow down the economy, and you're seeing that being reflected in the stock market as well. Continuing with this, price stability is really necessary for an economy to thrive. I mean, if you just look at some of the countries in the world that have really high runaway inflation, like in Turkey and some countries in South America, I mean, they're not great places to be, essentially. And so high runaway inflation, it starts to erode people's confidence in the government. It causes political unrest. So it's not something that you want to deal with on a long-term basis. And unfortunately, the Federal Reserve raising interest rates is something that it's going to slow the economy, and they have a really tough job because they want to keep the economy going strong, but they also want to control inflation. And so those objectives can be kind of head to head with one another. And so they're forced to raise rates because they want to get inflation under control. And the way that works is, if rates go up a lot, that makes your mortgage more expensive. That makes it harder to get an auto loan. So you're less likely to go out and borrow money and spend. And in that lack of spending, that lack of borrowing, that tends to have a contractionary impact on the economy. So if the Fed can kill demand, right now they're engaging in what's called demand destruction by raising rates to slow demand. That will hopefully give supply chains a little bit time to rebuild inventories, to come back online. And then if companies, maybe they overbuy their inventory now, and then they have to discount it to get it off their books, and so that would be deflationary. But at any rate, that it's not a good thing when the Fed has to raise rates aggressively, because it tends to put the economy into a recession. I mean, they don't want to do that, but if they feel that they have to in order to get inflation under control, they will, essentially.
And we had a question specifically about that. You provided a natural segue for this one, so that worked out great. Related to inflation, can you define what constitutes a recession in very basic terms?
Mhm.
And is it normal to have a recession when unemployment is very low?
Yeah, so that's a good question. So basically, I know how to define a recession, in finance jargon terms, but I'll try to convert it as best I can. I mean, it's basically when you have two back-to-back quarters of negative growth. So the GDP would be negative, 2 quarters in a row. So just in looking at that from in a more practical way, if people are spending less, borrowing less, buying less, and there's less economic activity for 6 months, essentially, that constitutes a recession. But the official way that it's measured is if the GDP reading is negative 2 quarters in a row, that would be a recession. And then if it's negative for, I think it's either 4 or 6 quarters, that constitutes a depression, which we haven't had in a very long time. And hopefully we won't have that. But so hopefully that answered your question.
Yeah, and then I don't know if you talked about how that relates to employment numbers.
Oh, yeah, sure. So it's not normal to have a recession when unemployment is low. Typically, if the unemployment rate, which is 3.6 right now, goes up 0.5%, in historical terms, it just keeps going up. And so
What keeps going up?
the unemployment rate.
Okay.
And so that would likely lead us into a recession. If you saw the unemployment rate start to go up and it went up by more than 0.5%, then we would likely be headed for a recession. But
because that means that our GDP, our gross domestic product, more people are unemployed. We're not making as much.
exactly.
As much
Yes.
product in the US.
Right, exactly. In a perfect world, the Fed would be able to get unemployment to rise just a little, just enough to get inflation to come down. And then they could hold rates steady and the economy would accelerate again, and that would be perfect. And over the course of history, they've never been able to do that. So what the Fed is trying to do right now is really, really difficult. Yeah, it's unusual to have a recession when employment's 3.6%. I would say that it probably will go up slightly. And if it goes up more than 0.5%, we could be in for some economic pain ahead. The unemployment is so low because, the economy is booming, because demand is so strong. But what's going on right now with the Fed and interest rates and high inflation, that's reducing that demand. And if that demand reduction starts to lead to higher rates of unemployment, then we could be in trouble and headed for a recession.
Okay. So that's that balance you were talking about with the Fed, is that
Right.
we've got to bring down demand, but we don't want to bring down demand so much
That it sends us into a recession.
that people can't get jobs, and then we're in a recession.
Yeah.
Okay, so that's a balancing act there. Thank you so much for explaining that. I appreciate it.
So the final point on the
Oh,
last
sorry.
slide is there's also a psychological component to inflation that the Fed is trying to control. So if people feel like inflation is here and it's permanent, it can become a self-fulfilling prophecy. And what I mean by that is, if you think prices are going up, what you're going to do is you're going to buy things now because you don't want to pay 10% more in a year. So you'd rather just shell out some cash and buy it now. So what that does is it puts even more pressure on demand when we're already in a supply constrained world. And so it raises inflation even more. So, you say I was right, prices did go up. Well, you were right because everybody thought the same way and everybody went out to rush to buy things before prices went up. So that's what the Fed wants to really prohibit, is they don't want inflation expectations to stay high. If they can lower those expectations, then they'll feel they've done their job. But so now we're going to get into some things of what can you do to fight against inflation. And one of the things that affects a lot of people is how does it affect your debt? So essentially when you have inflation, you want to borrow money because you're basically able to borrow money now and you pay it back in dollars that are worth less down the road. So if you were to if you locked in your mortgage at 3% a couple of years ago, and well now inflation's 8%, you're earning a real return on that money essentially, because that 3% mortgage that you have is being devalued 8% a year if inflation were to stay at 8%. So yeah, the textbooks would say go ahead and borrow more during inflation if you can handle it from a personal finance perspective, because you're paying back money in less dollars, and that's a good thing. The bad part of it is, as the Fed raises interest rates, the economy slows, the banks are going to tighten their lending standards. And especially if we go into a recession, it's going to be really hard to get that mortgage or get that loan, because, banks, after the 2008 financial crisis, banks are extremely conservative. They're nervous about making risky loans, so they really have tightened their lending standards, and would do so even more if we have economic uncertainty ahead of us. So just to sum it up one more time, with inflation, it's going to slow the economy, because if you get a mortgage now and you're paying 6% on it, more of your interest payments are going towards just the interest, essentially, and so you can afford less house. There's less money going towards the actual real estate. So it's gonna slow the economy that way as well. But again, if you can borrow at a low interest rate when inflation's high, that I would say leave your debt outstanding. Don't pay it down early if that's the case. But again, I'm not giving investment advice, but this is theoretical. So it's all dependent on your personal situation. I mean, if you've got a ton of debt already and can barely afford to pay that, don't go out and get more debt. So hope that makes sense.
Yeah. So this is, I had a couple of questions that came in, but I think I'm going to wait until maybe we reach the point in the presentation where they make sense. So let's keep going.
So when it comes to investing your money when there's inflation, so inflation is the enemy of cash, like cash just sitting there earning nothing. Like I said, if your cash is earning zero and inflation is 8%, you're having a negative real return. That's not good. One slight benefit that is bound to happen is that as the Federal Reserve raises interest rates, banks are ultimately going to have to start raising the rates they pay on your deposits. So you're likely going to see those money market account rates come up. Now there always tends to be a lag between when the Fed raises rates and when banks actually start to do it, because banks want to squeeze you as much as they can. But basically what's going to happen is you're going to start to see that 0.5% go to 1%, maybe 2%. And so you should just be aware of this and shop around a little bit, because banks will start to compete for your deposits with higher interest rates. And so if you can go to a local bank that's going to pay you a 0.5% more than maybe one of the big banks, then that could be worth it if you've got a lot of cash sitting around. You just don't want to have that earn zero. Another tool that has just become really popular this year has been a kind of obscure investment called an I-bond. And an I-bond is a bond. It's a fixed income product. It's issued by the US government. And what it does is it pays you the current rate of inflation. And that rate adjusts like every 6 months. So right now, if you buy an I-bond, I believe you're getting like a 9% yield on it. So it's really, really attractive. There are a lot of limitations. So there's a $10,000 limit on how much you can buy per person. So if you're in a household of 2, you can buy $20,000 worth of these bonds. and they're completely safe. They're backed by the US government. There's also some limitations on the holding period. So you cannot sell it within 1 year. And if you sell it within 5 years, you lose 3 months of interest on it. So if inflation stays high and you've got extra cash sitting around, I bonds are a great way to preserve the purchasing power of your money. Again, they're safe, and the government pays out the interest whenever you redeem the bond, whenever that may be. But if you don't want any sort of penalty, you need to hold it for at least 5 years. And so you can actually purchase these bonds by going to a website called treasurydirect.gov. And that's where you do it. It's all electronic, but check that out if you're interested, because that, it's one of those things that has not really been front and center, but now with inflation where it is, it's a great investment right now. Traditional like corporate bonds and CDs, not a great investment when inflation has gone as high as it has. It's forced bond prices lower. So normally fixed income and bonds, they're a great hedge to stock market risk, because historically when stock markets have gone down, bond prices go up. That has not been the case this year, because you've had stock market go down, inflation go up, and that's pushed rates up, which pushes bond prices down. So it's been a tough year for basically any sort of fixed income asset class. Even TIPS, which are Treasury inflation protected securities, theoretically should protect against inflation, but they trade based on the expectation of inflation, and they're down like 10% this year. So even investments that theoretically should help you have had a tough time hedging against inflation. But those I bonds, I think that's one of the best ways to do it. But other fixed income products have not really helped you at all this year.
All right, we have a couple questions about this, and I know we have some more to talk about investments, but I thought we might talk about cash. So someone asks, if you have an emergency fund that you built up and it's sitting in savings and inflation is eroding its value, do you move it out? Do you keep it in? And I would just reiterate that this is a emergency fund. So I'm assuming this person will want to keep it liquid in case of emergency.
Yeah. So that's like rule number one of financial planning, is always have an emergency fund. Now it's typically anywhere from 3 to 6 months of your living expenses, more if it's only a one income household. So you want to keep that completely liquid. I would still look around, because if it's in a money market account, you still have access to it. There's no penalty for withdrawing it. Money market accounts are probably going to pay you a higher interest rate than a savings. So in that case, I would just be shopping around for probably the most competitive money market rate you can find. Because again, you just want to keep it completely liquid. Don't put it in something where that value is locked up for any period of time. All
right, and then I want to let the person know that when we talked about, who asked about borrowing and debt, we've already covered that, but we will come back to it during the question and answer period. I want to let you know I saw your question, and we'll just come back to it during the question and answer period. Let's go ahead and move on to this next part here.
Yeah, I think this is more the exciting part of the investments. But so, long term, excuse me, in a historical context, stocks do tend to be a good hedge against inflation. And when you think about what the stock market is, a collection of publicly traded U.S. companies, those companies, they're raising their prices, they're investing in automation to try to maintain their profit margins. So they have, many of these companies have pricing power, so their earnings are growing every year. And what you want are companies that grow their earnings faster than inflation, which typically the stock market has over the years. So while this year is a bit of an anomaly in that sense, long term, stocks typically are a good hedge. Now what's going on this year, I think that's a little unusual, is that the dispersion in returns within the stock market is extremely wide. And so I posted this chart that you can see here. This is from the beginning of June, but you see energy, the energy sector in the S&P 500 or the Russell 3000 I have here is up 60% year to date through June 3rd, whereas consumer discretionary is down 23.4%. So historically, I mean, most of the sectors you don't typically see that kind of sector dispersion. And it kind of makes sense when you think about it. Like, energy is a pure commodity, and we know the price of oil has doubled over the past little while. And so it makes sense that energy companies are doing very well this year. And on the bottom end of this, look at like consumer discretionary, where the first line of spending that people cut when they start to get squeezed in their paychecks is discretionary spending. They won't go to the movies, they won't go out to eat, they may drive their old car another year. So you're starting to see spending kind of deteriorate a little bit around the margins. And so the companies that do have pricing power in energy are doing very well, whereas companies without pricing power and maybe have to discount or are in the discretionary sector are not doing so well. So similarly with utilities, consumer staples, these are two areas that don't tend to be too price sensitive. Whatever your electric bill is, you're going to pay it. And whatever your grocery bill is, maybe you can make some substitutions, but these are areas with pricing power that you pretty much have to pay the price no matter what it is. And in those types of companies, should do, excuse me, a little bit better during an inflationary period. It's even true with like financials. So banks should do well when interest rates are higher. They can charge more on their loans, and they should be able to have a little bit of inflationary protection if they can reinvest all their extra cash at higher interest rates. Then that should be good for banks. So the market tends to be a good hedge against inflation over the long term. But when you look in the stock market, the sectors that have the lowest amount of price sensitivity, I think, are even better hedges. The second point here, raw commodities, those are things like oil, gas, copper, aluminum, nickel. Those commodities are going up a ton. They've gone up a ton in the past year and a half or so. And again, it just goes back to the whole supply demand dynamic, and we've not invested in enough production of oil and gas in this country to be able to meet the demand right now. So prices have to go up. And so commodities tend to be a very good hedge against inflation. They're very volatile though, so I'd be careful with that. But if you expect inflation is going to stay high for a long time, commodities should do well. Now, what has not done well have been really speculative assets. These might be like cryptocurrencies, real high growth technology stocks that maybe aren't profitable yet. And part of the reason for this is, if there's a tech stock that is growing a ton, maybe they're not profitable, but they think, in 10 years, we're going to make $1 billion. Well, if you have a lot of inflation going on, that $1 billion that they're going to make 10 years from now is effectively worth a lot less today, especially discounting back for inflation. So you need to see kind of a big price adjustment downward in that particular stock to kind of offset the inflationary effect over time. So that's why you're seeing a lot of these high tech stocks really come down in price a lot. And some of these things were really bid up during the pandemic. And I think there was a whole army of day traders that kind of was started during COVID, and people had stimulus money and they were making really speculative investments. So there's a little bit of froth in the market in that space there that's kind of come back a little bit. You're especially seeing that in the cryptocurrency world. That's another area where I think the Fed raising rates, it creates less incremental dollars to flow into speculative assets. And what I mean by that is, if you have an extra $1,000 sitting in the bank and it's earning 0%, and someone tells you about a cool technology stock or cryptocurrency, you would think, hey, well, my it's not earning anything anyway. Maybe I'll just think of this as really a long-term type of thing, and I'll put it in this more speculative asset. Well, if that same $1,000, maybe now is going to be earning 2, 3, 4, 5% interest, you're less likely to pull it out and risk not getting a safe return and then putting it in something that you could lose a lot of money. So that interest rates going up is kind of reducing some of the speculative activity on the margins here. And crypto is a space it's rife with speculation right now. So it's not surprising what's going on. And then the final piece here, real estate is a great hedge against inflation. And this would be like direct ownership of real estate. So, if you own a house, if you own a house, you're probably looking at Zillow and seeing the price go up a lot in the past year, and that's great. Certainly, if you own multiple properties, I'm sure the values have done very well, just given what's going on in real estate. So that's another really good hedge to inflation, because essentially the replacement cost of that house goes a lot up when you've got all the materials that you need to build the house, the labor, everything else is going up. So that real estate tends to be a very good hedge against inflation. I'll point out here on this chart, the stock market chart that I have, inflation is negative. Real estate, is negative this year, whereas in reality, home prices are up 20% year over year, or whatever they are. So the real estate stocks out there, I think, just tend to trade more in line with the general market. So even though maybe the value of some of these companies' property that they own is going up, the real estate stocks are just kind of selling off with the general market, just because there's not a whole lot that's positive right now. So just wanted to point that out.
I do have a question that relates to investing, and maybe we're going to get to it later, but I do want to make sure this person gets their question answered. Would it be advisable to stop temporarily putting money into investment accounts, such as a Roth IRA, 401k, being that the returns are negative right now?
I would say, that is like kind of specific to somebody's personal situation, but like if you were asking me in a vacuum, everything else being equal, I would say you want to continue to fund like a Roth IRA. I think the fact that the values are down makes things more attractive from a long-term perspective. And when it comes to retirement saving and investing, if you have a really long time horizon, what's more important is kind of just staying on a plan and maintaining that plan over a long period of time. And you almost want to block out like some of the scary stuff going on right now, because typically when the level of fear is high, it's typically a good time to invest. And then when the level of euphoria is high, like it was in 2020 when Bitcoin was going to the moon, that's the time you want to be taking risk off the table. So I don't think it's a bad time to be investing. And if you certainly have a plan where you're consistently contributing to a retirement account, I would not stop it given what's going on right now. And so, where is it going from here? I alluded a little bit to this earlier. I don't think it's going to stay at that 8-9% level. But the real question is, when is it going to start to, or when it does moderate, at what level is it going to settle in? It's likely, again, like I said, to stay above that 2% rate that's been the Fed's historical target. The Fed has said that they'd be willing to let inflation, they call it run hot for a little bit, because it's been below their 2% target for so long. So I do think that there's a good chance that it does run above that target. And it's not just, what the Fed wants. Some would argue they can't control anything, but there all are these structural issues going on right now that I think is going to create higher inflation. And that's this kind of re-onshoring of public US companies and investing domestically. I think that's going to have an inflationary effect. And on a higher level too, I mean, the demographics in the US, it's getting, we're having more and more old people, more and more retirees. No offense to anybody out there, but it just puts strain on the system, and we have a lower proportion of people that are in their prime working age. So we have a lack of workers. So I'm thinking that increased domestic investment combined with a lack of labor, that's inflationary. And so that's why I think it could stay a little bit higher than it has been in the past. It's not going to stay at that 8 to 9% level, just because you're going to have supply chains come back online. You're going to have these higher rates that the Fed's raising rates and creating higher mortgages and higher short-term lending. That's going to slow demand a little bit. So that should have an effect that brings inflation down a little bit. And finally, just when you're measuring inflation on a year-over-year basis, you're not likely to see the massive increases in commodities that we've seen in the past year. Yeah, so really, to sum it all up, it's been the perfect storm since COVID. It created a wave in demand coupled with this lack of supply, and so prices had nowhere to go but up. And it does have potential to remain at elevated levels for everything that I talked about. And I think the big thing to remember is, you don't want to be earning zero on your cash. So you're seeing a lot of short-term interest rates go up. If you're very risk averse and want your money somewhere safe, I would start to shop around for higher money market, higher CD rates. The banks are going to be forced to compete with one another again for your deposits. So you should see these rates go up. I think I bonds they're a phenomenal opportunity right now, given where inflation is. I mean, there's not that many investments out there where you can make a risk-free 9% right now. And again, that will likely reset downwards over the years as inflation comes down. But it's certainly a really good proposition. So if you have excess cash, that would be a outside of your emergency fund, that would be a good use for it. And then, like we talked about with the debt, I mean, if you have debt outstanding and you're locked in at a low interest rate, high inflation would be a reason to not pay your debt down and leave it out there, because you're essentially paying back the bank with dollars that are worth less today than they were when you borrowed them. So it makes sense from that perspective to leave your debt outstanding. And then
I think what we're going to do is we're going to open it up to a couple questions. We don't have a lot of time, but we'll go ahead and do that. This is a great one. Is inflation high worldwide or only in the US with COVID and the Ukraine war?
Yeah, no, that's a good question. It is high worldwide. It's hitting 40-year highs in Europe as well. And I'm sure in emerging markets it's high as well. Just from the fact that we have a lack of supply of oil and gas because we're trying to isolate Russia economically from the rest of the world. Emerging markets and undeveloped countries, they need a lot of raw commodities. They need oil to continue to grow and develop. And the fact that oil has gone up so much, it's creating inflation everywhere. And this whole supply chain in disarray phenomenon that's going on, I mean, that's a global thing too. So yeah, you're really seeing inflation. It's running wild all over the world, not just the US.
All right, and then I think we have time for one more question before we have to close. Can you talk a little bit about people who are in retirement, maybe not in the accumulation phase? What might be some strategies to preserve that wealth that they've built up when they are drawing down on it as opposed to adding to it?
Yeah, sure. So I mean, I still think for folks that are retired and they're starting to distribute some of the money they've built up over their lifetimes, it's still important to have some exposure to the equity and fixed income markets. I mean, I think again, going to cash, some people are very uber conservative and it sounds like a good idea, but you're earning a negative real return if you do that. And ultimately, I think what's gone on in the stock market and the bond market, it's very unusual to have them both be so sharply negative. And while it is scary, I think that it's not likely to continue. In the fact that interest rates have gone up so rapidly, I think going forward, fixed income and bonds in general should start to be a better hedge against the stock market, because they're not starting where rates are zero. They're starting up now where rates are, 3.5% or so on a 10-year treasury. So I think that there's room for rates to come down if something bad happens economically, and that would cause fixed income prices to go up. Yeah, but again, I mean, I would, if someone in that position, I would just maintain a conservative asset allocation, but you still want to have some growth in the portfolio, have some assets that are kind of hedges against inflation. So I hope that's helpful.
Yeah, and this is of course just general
General.
tips. And please, if you have a financial advisor that you feel comfortable with, go ahead and talk with him or her about your individual situation. And then we are going to end now. And if you don't have a financial advisor, that's what Advice Chaser is here for. Ethan, thank you so much. I want to say we've also got some great thank yous in the chat. Go ahead and let Ethan know if you appreciated this content. I think they agree with me. This is very, very informative.
Well,
So
thank you.
absolutely. Well, on behalf of Advice Chaser, we want to thank the organizations that have worked with us to bring you this webinar today. Thank you so much for attending. Look for an email soon for a link to the replay of this event. We will also post it on our website, and you're welcome to share that replay or share that link to the website with your friends or family if they're also interested in this topic. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. And we're getting lots of thank yous in the chat. I appreciate that, folks. Thank you so much and have a great day.